Hello, everyone. Adam Bergman here, tax attorney and founder of IRA Financial. On today's show, I'm going to be talking about the tax basics of the self-directed IRA that you need to know. It's going to be a fun show because I get to be a tax lawyer again. So I am going to spend the next 15, 20 minutes telling you everything you need to know about the tax rules surrounding self-directed IRA. And why should you trust me? Good question. Well, I'm actually a tax lawyer. I have a master's in taxation. I've worked with some of the largest law firms in the country for 9+ years as a tax associate. And I've written 8 books on the self-directed retirement account. So you're not going to find really anyone in the country that knows this stuff better than me. Now, not to say that I'm the smartest person or lawyer out there. No, but I know this stuff better than anyone in the country. You can ask my wife. I don't know a lot about many other things, but I know a lot about this. So hopefully you're watching, and hopefully you're going to spend some time with me and listen and learn and ask some questions too. Feel free to. Just a great way to learn. But I'm going to tell you everything you need to know about the basic taxation rules of a self-directed IRA. So the first thing to remember is IRAs were created in 1974. And a self-directed IRA is an IRA. You're not going to see the word self-directed IRA anywhere in the tax code. It's not a legal term. It essentially just means an IRA that invests in alternative assets. So you can call the self-directed IRA anything you want: alternative IRA, alt IRA, IRA Financial IRA, whatever you want to call it, you can call it. But this is the truth. 1974, ERISA created IRAs and 401ks. ERISA didn't distinguish between IRAs that invest in stocks and IRAs that invest in real estate. Just simply set forth the rules of IRAs. And the reason IRAs were created, trust me, I'm getting to the whole point of this video, is that they wanted to incentivize us all to save. They understand that we are a private retirement system, unlike some European countries where there's a public system where the government provides a pension for you. In the United States, we have Social Security, and we have our own private retirement system. So it's up to us to save. So how are they going to incentivize Americans to save? Americans, we love to spend money, right? We're great consumers. This is the land of plenty. We're very good at spending money. So how do you incentivize us to save? Well, they did 2 things. First thing, for traditional IRAs, they said, okay, if you make an IRA contribution, we're going to give you a tax deduction for the amount you put in. So everyone likes tax deductions. Why? It lowers your taxable income. Who's going to turn that down? 2, and this is the whole point of today's video, is they introduced the concept of tax deferral. Tax deferral means that when you make an investment in your IRA, it is not subject to tax, not ordinary income tax, and not capital gains tax. No tax. And this is a concept that's very difficult for some folks to understand. I get this question 30 times a week. Okay, Adam, so I'm going to sell this asset in my IRA. What's my capital gains tax rate? I'm like, no. There's no tax rate. Zip, zero, zilch, nada, nothing. That is the beauty of investing in an IRA, is your money grows without tax. That's known as compounding returns. Albert Einstein, I've said this many times. 8th wonder of the world, compounding returns. Your money grows faster when it's not subject to tax. If you average an 8% rate of return, your money should double every 8 years. So those were the 2 elements that the IRA Congress introduced in ERISA to incentivize all of us to save. Number 1, tax deduction. Number 2, tax deferral. Now, the whole concept of tax deferral was taken a step further in 1997 when Senator Roth of Delaware introduced the Roth IRA. And the Roth IRA is a take on the traditional IRA. Unlike a traditional IRA, as I mentioned, where you get a tax deduction for making a contribution, in a Roth IRA, it's an after-tax contribution, meaning there's 0 tax deduction. But so long as you're over 59 and a half and the Roth's been open at least 5 years, it is all tax-free. Okay, so you have to be over the age of 59 and a half, and the Roth has to be open at least 5 years. You can pull out all the Roth contributions and earnings tax-free. Now, let's talk about distribution rules. So what could potentially limit your ability to defer income in a retirement account? Well, number one, unlike a 401k, you don't need to trigger an event. You can pull money out of an IRA or Roth IRA anytime you want. The downside is there could be some tax. So let's start with the traditional IRA. If you take a distribution before the age of 59 and a half, whatever you pull out is subject to tax and a 10% penalty. Now, there are some hardship exemptions that will allow you to pull money out of an IRA with just tax, no 10% penalty. But in general, if you pull money out before the age of 59 and a half, the amount you pull out is subject to tax and a 10% penalty. It's the fair market value of the cash or any asset you pull out. Now, on the other side of the spectrum, once you hit the age of 73, which is the new required minimum distribution age, so thanks to the Secure Act 2.0, you have to start taking RMDs, required minimum distributions, which is a percentage of your overall IRA value, approximately 3% or so a year. So those are the two factors that could ultimately reduce the amount of money in an IRA that would take advantage of the power of deferral. Now, let's go to the Roth IRA. With a Roth IRA, if you make a contribution to a Roth IRA, you can pull those funds out anytime you want, those contributions amount. So if I contributed $3,000 to a Roth IRA today, I can pull that money out tomorrow tax-free, right? It's after tax. But the earnings on the Roth IRA, which is the juice, right? That's where all the growth is. That is subject to the 59 and a half and 5-year rule. So you got to be super patient in a Roth. You got to trust the process. But if you can wait to your 59 and a half and the Roth's been open at least 5 years, all the Roth IRA distributions, contributions, and earnings are tax-free. So that's super exciting, right? That is the ultimate tax shelter. I've written a book called In God We Trust and Roth We Prosper for a reason. Personally, I'm a huge Roth fan. All my retirement savings are in Roth. Yeah, there's a downside, right? Downside is I don't get a tax deduction, and I have that battle with my accountant each year. I max out my 401k with IRA Financial and Roth every year. I also do a backdoor Roth IRA. What's a backdoor Roth IRA? Well, starting in 2010, the IRS got rid of income limitations for Roth conversions. Prior to 2010, if you made above 100K or so, you couldn't do a Roth conversion. 2010, they got rid of that exemption because Treasury needed money thanks to our financial crisis. So they cut those rules and said anyone can do a Roth conversion. And Congress loves Roth conversions. The IRS loves Roth conversions. Why? It's because you pay tax prematurely, right? Let's say your traditional IRA is worth 100K and you move it to Roth, you're going to pay tax, ordinary income tax, based off the $100,000 fair market value. Whereas if you just kept it in an IRA and did not do a conversion, they'd have to wait till you're 73, or if you took a distribution to get some of that taxable income. So they love conversions. It just gives Treasury more cash, and obviously everyone in Congress and in Washington loves more money to spend, right? The more pet projects they have to spend on, the more things they can go back to their constituents and say how great they are. So conversions are a big win for members of the House, Senate, the whole Washington establishment. But for us, we love conversions too. Why? Because you're able to get assets that are pre-tax into Roth. And the idea is so long as you make good investments, right? You don't invest in Enron or a number of other companies that didn't make it over the years, you're going to be quite happy. Even if you just invest in the regular S&P 500 or real estate, you can assume you're going to average around 8 to 12% a year. So just getting that cash flow and growth in a Roth, so long as you can wait to your 59 and a half, Roth's been open at least 5 years, you can pull all the money out tax-free, which is obviously huge tax win. So from an IRA standpoint, from a number one thing to remember is when you make investments in the IRA, they're subject to no tax. That's known as tax deferral. If you do it in a Roth IRA, it's tax-free. The only way you limit your ability to grow and take advantage of tax deferral or tax-free investing is through taking a taxable distribution, or in the case of a traditional IRA, being over the age of 73 and subject to RMDs. Roth IRAs do not have an RMD structure, meaning you do not have to take money out of your Roth IRA at age 73. In fact, you don't ever have to take money out of your Roth IRA. If you pass, it will go to your spouse tax-free. And then if your spouse passes, then your beneficiaries, non-spousal beneficiaries, will generally have about 10 years to pull those funds out. So from a estate planning perspective, Roth IRAs are quite attractive because your spouse or your kids or your heirs would not have to pay tax on any of the distributions they pull out as a result of having an inherited Roth IRA. So that's step one. So most investments in an IRA are not subject to tax, right? There you can take advantage of tax deferral. What are the most common types of income generated in an IRA? Well, essentially it's passive types of income, right? Buying and selling stocks, real estate, cryptos, notes, private placements, hedge funds, private equity, liens, deeds, right? Selling of an asset. That generally is a capital gain transaction, right? Capital gains are passive. They are not subject to any tax within an IRA. Same goes for rental income. Rental income is passive. It's not business income. It's not subject to any tax in an IRA. Same goes for interest. If you are a lender and lend money to folks and they pay your IRA, the interest received is not generally subject to any tax in the IRA. Same with dividends, right? If you own a stock that pays dividends, public or private, dividends go back through the IRA without tax. Same with royalties. Maybe you own some type of patent, intellectual property. The royalties are passive and they flow back to the IRA without tax. But there is a small segment of transactions that if your IRA engages in could generate a not pretty little known tax known as the unrelated business taxable income tax, also known as UBIT or UBTI. And that's the second basic tax matter that you must understand and at least explore when making an investment with a self-directed IRA. What is UBIT? So UBIT is triggered only in 3 instances. One, if your IRA invests in a transaction where there's leverage, right? Let's say you buy stock with leverage or you buy inventory with leverage. Okay, that use of the leverage triggers this UBIT tax. Number 2, if your IRA invests in an active business like a restaurant or a consulting company or a bank, and that business enterprise is operated through an LLC, limited liability company. If the business is operated through a C corporation, there is no application of the UBTI tax. Why? Think of a C corp as a big square box, and it boxes in all that income, and the C corp has a corporate level tax. So the UBTI tax doesn't need to apply because the corporate tax already applies to the income, right? Corporations have 2 levels of tax, one a corporate level of 21%, and then second a shareholder level based off dividends received. Whereas an LLC or a pass-through entity has only 1 level of tax. There's no entity level tax, right? Think of a partnership as like a funnel. Only the member would pay a tax based off their ordinary income or tax rates or capital gain tax rate. So unfortunately, that's why the UBTI tax gets imposed on the LLC or the pass-through entity, because there's no corporate level tax. Now, ultimately, and I've talked about this many times before, the UBTI tax really shouldn't apply to IRAs. It was put in the tax code in the 50s to apply to charities, tax exempts, right? The idea is that you don't want tax exempts to run businesses because then everyone would just set up a charity and run their business through a charity and never pay tax. So they created this regime known as unrelated business taxable income tax, where if the tax exempt operates an activity that's not part of its exempt purpose, right? That's why the tax is known as unrelated business taxable income, i.e. a hospital operates, an ice cream shop, or hospital operates a candy store. That is not correlated to its exempt purpose. And that's why the UBTI tax would apply to that income. But IRAs don't have an exempt purpose, right? What's the whole point of an IRA or 401k? It's to grow, to make money, right? It's not to save lives. It's not to educate people on, certain matters. It's to grow. So it doesn't have an exempt purpose. It's not like a hospital. It is treated as a tax exempt under 501, That's why it gets stuck into the UBTI regime, but it's not correct. And I've had conversations with members of the Ways and Means Committee, both Democrats and Republicans. They seem to understand this, but there's just no momentum to get this eliminated. Why? Because Congress makes money. IRS generates revenue from UBTI, right? It's 37% tax. That's the maximum tax rate. Follows the trust tax rates. It gets imposed at a certain super low threshold of approximately $15,000. So why would they eliminate it, right? They're getting retirement accounts to pay it, but it's unfair. That's why they should eliminate it. That wasn't its intended purpose. Intended purpose, again, was to stop businesses from setting up charities or stop charities from operating businesses. And that's the name of the tax, the unrelated business. Well, IRAs don't have an exempt unrelated purpose. The IRA's purpose is to make money whatever it invests in. So anyways, that is the second basic tax fact to remember is UBTI. 90% of IRA investments do not trigger UBIT, right? Most of you probably never heard of UBIT. If you are just investing in stocks or real estate, not using leverage, you're not going to have to deal with UBIT. But what are the common transactions that trigger UBIT in a self-directed IRA? Number one, if you invest in real estate using leverage, right? If your real estate uses a loan and the loan must be non-recourse. Why? Internal Revenue Code section 4975C says you cannot personally guarantee an obligation of your retirement account. So that's why you cannot personally guarantee the loan. That's why you can't get a traditional mortgage. You have to get a non-recourse loan, which is more expensive, higher points, why the lender is taking greater risk. So again, just to recap, the three types of transactions can trigger UBIT. Using a loan to buy an asset like stock, using a non-recourse loan to buy real estate. There is an exemption for 401ks, but for purposes of today's video, I'm focusing on self-directed IRAs. Thirdly, as I mentioned, if your IRA invests in an active trader business, like a restaurant through a pass-through entity like an LLC. IRAs cannot invest in S-Corps. That's why I did not mention S-Corps. Why? Section 1361 of the tax code does not allow an IRA to be a shareholder of an S-Corp. S-Corps are very specific and rigid shareholder rules. So what are some transactions that trigger UBIT? I mentioned using a non-recourse loan to buy real estate, investing in a real estate fund with leverage, investing in a hedge fund with leverage, investing in a private placement through a pass-through entity. Maybe your friend is starting up a business and it's going to be operate through an LLC. If there's more than $1,000 in net income, the UBIT tax can get triggered. As I mentioned, the tax rate can go as high as 37% at a very low income threshold of about 15%. And you have to file a 990T by April 15th to pay that tax. Now, the good news is we handle that for our clients. We have an amazing tax accounting service, which I'm actually going to do next week's video on to kind of introduce it, where we do 1065, 990Ts, 1099Rs, and obviously 5500 EZs, all for free, included for any client that pays our annual compliance fee. So it's an awesome accounting service, the only company that does it in the whole country, and we're super, super psyched about it. So I'm actually going to talk next week all about it and kind of introduce it, which is going to be huge help. Known as the unrelated business taxable income tax, or UBIT, and that only gets triggered in three instances. One, you use a loan to buy an asset. Two, use a loan to buy real estate. And three, you invest in an active trader business through a pass-through entity, such as an LLC. Third tax fact to remember using a self-directed IRA is if you are engaged in a structure using an LLC. So let's say you have a self-directed IRA and it has an LLC known as checkbook control. Why would you do that? Well, obviously you want limited liability protection, which protects assets outside of the LLC, maybe privacy. You want more control. How does the checkbook control structure work? Well, the LLC is wholly owned by an IRA. You manage the LLC as per the LLC operating agreement, giving you as manager and IRA owner checkbook control. And then through that process, you can go out and make investments on behalf of your IRA. Now, it's not essentially a tax, but things to understand is that LLCs have annual filing or franchise fees. The establishment fee, obviously, we cover, but on an ongoing basis, your IRA LLC will need to cover state filing fees, state administration fees, state franchise fees. Most states have a range of anywhere from $0 to a couple $100, which needs to be paid by the IRA. California is the only state that has a huge franchise fee minimum of $800. That's the exception, not the norm. The norm is $0 to $200. So that's not a tax, but it's a fee that is imposed on an IRA only if they use an LLC to engage in investments for purposes of limited liability protection, privacy, and greater control. So just something I want everyone out there to be aware of. Not a tax, but a tax filing / cost. And then the fourth basic tax item to consider for self-directed IRA, again, falls in the category if you are using a self-directed IRA LLC. If you have a multiple member LLC, so a self-directed IRA using an LLC, and there's 2 or more partners, could be 2 IRAs, could be an IRA and an individual, IRA and a 401k, an IRA and 30 individuals, whatever it is, that LLC needs to file a partnership return known as a 1065. That's due March 15th. This is not a tax. Okay, as I mentioned, LLCs, multiple member LLCs treated as partnerships. They're flow-through entities. They're pass-through entities. There's no entity-level tax like a C corporation. But there's still a partnership return, which is more of an information return, just to provide the IRS a snapshot of what the partnership's done and who the partners are, the capital accounts of the partners, what the value of their accounts are, and some of the activity within the partnership. So this is a return that's due to federal and state return. There's a K1 that's associated with this return. You probably have heard the term K1. K1 is part of the 1065, and it just goes to the partner, i.e. the IRA, and to the IRS, and gives the IRS a snapshot of the partner status in the partnership. Again, it's not a tax due return. It's not like your 1040 where you could owe tax. This is purely informational, but it must be filed. And we handle it for any client as part of our annual compliance service. We'll help file the 1065 and the K1. That's due March 15th, and we can help you file an extension to September 15th. So not tax due, but that is a tax obligation as part of the self-directed IRA. Number 5, what are some of the other tax-related matters one should be aware of in a self-directed IRA? This 5th category, you don't have to worry about. Why? Because if you use IRA Financial or any self-directed IRA custodian, we handle all the annual IRS administration, i.e. 5498s, 1099Rs if you take distributions, make contributions, conversions. We report all that to the IRS. So that's why you pay us our annual fee. Obviously, you get amazing service on top of that, but our main duty and role is to provide the IRA with administration services, i.e. completing Form 5498 and 1099R. 5500s are for 401ks. A lot of people think IRAs have to file 5500s. That is not the case. The only tax filing for the IRA, not the LLC, but for the IRA is the 5498 and the 1099R. We handle all of that for you. So don't have to worry about it. The first 4 categories, that's something that the IRA owner needs to be aware of. If you are a client of IRA Financial, this is part of our annual consulting services where you have access to our tax professionals so you can engage in conversation on these matters. But just to recap, number 1, tax deferral, tax-free. We can help you understand traditional IRA versus Roth IRA, which makes sense. Number 2, I mentioned, obviously, unrelated. Well, actually, number 2, before I get into unrelated business taxable income, number 2, we want to mention distributions, right? You have to understand that what can limit the availability of deferral for tax-free growth is if you take distributions premature or at requirement and distribution age of 73. Thirdly, you want to be aware of unrelated business taxable income, UBTI. You also want to be aware, if you have an LLC, that there could be annual filing fees depending on your state. Again, if you're a client of IRA Financial, you'll receive all that information. And on top of that, if you have an LLC with multiple members, could be 2 IRAs or 2 or more parties, 1065 is due by March 15th. That is just an informational return. And then obviously, if you use IRA Financial, if you have a self-directed IRA, or even if you just have an IRA at any financial institution or bank, they will complete the 5498 and 1099Rs on an annual basis for your IRA. So that is one category you just don't have to worry about. The other four you want to be aware of. You want to understand the rules for traditional IRA or Roth, what makes sense for you. You want to understand conversions. Should you do it? Conversions are subject to ordinary income tax, not capital gains. Obviously, you have to understand if you take a distribution prematurely, what's the risk? What's the cost? Tax, penalties? Are there workarounds? Maybe if you have access to a 401k at work or a solo K, you can do a loan that will give you up to 50K tax-free, penalty-free without having to pay tax and an early distribution penalty. Maybe you satisfy a hardship. On top of that, if you're doing the LLC, you want to think about what state you want to file in, filing fees. If you're in California, do you need to do a California LLC? Are there workarounds? What state makes the most sense for your LLC? Is it where the investment is, where the real estate is, where you are? All these things matter and are elements that that we will discuss with you. And then ultimately, if there's a partnership, you're going to want to let us know, because we're not going to know if your LLC, in some cases, has more than one IRA, right? You're going to have to let us know, or more than one party. And if you let us know, we'll obviously assist you with the filing of the 1065 and the K1. And then the last one, the 5498's 1099R, we know that, right? We're custodian, we know, and we handle all that. The only thing we require from you is to provide us a valuation of your IRA, which you guys do. If it's not a taxable event, meaning you're under the age of 73, or you're not taking a taxable distribution or conversion, you can, if the asset's a liquid and essentially static, like maybe an investment in a private business, technically you potentially use the value of what you invested in. If it's real estate, you can go online and get a valuation. So it's not super difficult from an annual compliance standpoint for you to just provide us the necessary information so we can do our job and follow the 5498s and 1099R. But just to summarize, put it all together, the beauty of a self-directed IRA is that when you make investment, it's tax deferred, it's tax-free in the case of a Roth. There's no tax, no ordinary income tax, no capital gains tax. That means you don't have to worry about basis, holding period. You don't have to worry about your tax rate. You don't have to worry about your 1040. It's super, super clean and easy. That's why, for me as a tax lawyer, I love the self-directed retirement space and the entire retirement industry. Why? Because it uses the tax code in the best possible way. It takes advantage of everything I believe in, right? As a tax lawyer, the ability to compound returns, the ability to take advantage of deferral, tax-free growth, and allow you to self-direct, control, and have the freedom to make the investments you know and want. It's the most American thing I can think of that is in our tax code. You get to control your own investments and you get to reap the rewards because the money ends up in your pocket, not the government's pocket. And that is especially true in the Roth IRA. Now, if you do things well and start off in a Roth and keep growing your Roth, then ultimately you'll have all that money in your pocket. You can self-direct it. You can buy real estate. You can do stocks, private placement, private businesses, US, foreign, cryptos, gold, whatever you want. You have freedom. You have the control. And ultimately, it should be that way. Why? It's your retirement, right? We can rely potentially on Social Security, but that's it. The government doesn't owe us anything else. We're born into the greatest country in the world, but that's kind of all we get, right? We get freedom, right? That's what we're promised. So the beauty of the U.S. retirement system is it's almost as free as you can be. Yeah, there's 3 prohibited transaction rules. Can't do life insurance, you can't do collectibles, and you can't do any transaction involving a disqualified person. The disqualified person is the IRA owner and any of his or her lineal descendants, parents, children, spouse, daughter-in-law, son-in-law, or any entities controlled by such person. That means 50% or more. So other than that, you can do it, right? As I mentioned, stocks, private placements, hedge funds, private equity, real estate funds, real estate, hard, commercial, residential, cryptos, NFTs, digital, fractional real estate, gold. You almost can do anything you want. other than those three categories of investment. So it's takes advantage of the true beauty of being American is freedom, the ability to control your own life, not having the government tell you what you can do. In some countries, you're limited in what you can invest in. And I'm actually going to do a podcast coming up next week about state IRA programs and what's happening. There's 11 or 12 states that have imposed IRA programs, which in essence makes sense, right? Companies of a certain size are basically saying, if you don't have a 401k, we're going to force you to offer an IRA to your employees. And on paper, it's great, right? You want more people to save. What I don't like is it's forcing small companies. In some cases, like California and Oregon, it's all companies. Other states, it's like 5+ or 10+. But that puts a burden on the employer, small business. Maybe you own a coffee shop or small consulting firm, and now you have to get into the retirement business. I'm not sure that that's kind of fair. I think the intent is good, and I applaud the intent, but is it really fair? Should the employer be responsible for their employees' retirement? No, maybe all they should do is educate them, but that's probably it, right? Should they go above and beyond? Not my call, but I think if you listen to my podcast, which will drop next Wednesday on Adam Talks, you can hear more about it and what states are doing. Started back with the auto IRA with President Obama, that kind of fizzled out, and now a bunch of states have put on the books or on legislation these state IRA programs, which again make sense and they're great, but forcing small businesses to get into the retirement business, basically become the Department of Labor, that's kind of a burden. So I'm kind of torn, but otherwise you have a lot of options using a retirement system to essentially take advantage of the most powerful mathematics out there for wealth creation, and that's tax deferral, compounding returns, and tax-free growth. So got one question, James. We're moving from Gemini to Bitstamp. That's happening in February. We'll be sending information on that. So more to come, but we're super excited about that new platform. It's going to be awesome, and it's going to be right on our app. So you're not going to have to even go through Bitstamp. You'll be able to just buy, sell cryptos directly on our app. We've been working on this for over a year, so super excited, and that's launching within the week. So more to come on that. But thanks for the question, James. Otherwise, that's a wrap. Okay, so hopefully now you understand the basics of taxation of self-directed IRAs. And the trick question is there's no taxation, right? It's all tax deferred and tax free. But I mentioned unrelated business taxable income, 4-letter ugly word that could rear its ugly head if you're not careful. I mentioned state tax filings if you have an LLC, partnership returns if you have an LLC with multiple parties, and obviously if you don't have to worry about 1099-Rs and 5498s if you're for IRAs. If I opt out of the annual compliance service, will you need to file the 1099 or 5498? Well, if you're not our client, we don't do it, Dan. So any client of IRA Financial will still do the 1099-R and 5498s. If you pay, we also have on top of that an annual compliance service, and for that we'll file 1065s and 1065s, 990Ts, and also do all other annual compliance tax advisory services plus updates for operating agreements, things like that. But yeah, as long as you're a client of IRA Financial, Dan, we'll do the 5498s, 1099-Rs. If you want help on 1065, 990T for UBIT, LLC help, operating agreement help, tax advisory help, that's the other compliance service, which I'd say 92% of our clients engaged in it. It's a couple $100 a year. It's not expensive, right? You can pay it out of your IRA. It's really not a big deal, but trust me, you're not going to find an accountant or a lawyer that's going to give you this type of advice for a couple $100. You're never going to find it. So we offer that. The fact that so many people pay allows us to spread the cost, and we have an amazing team of tax professionals that are available to assist you, whether it's establishment, ongoing administration, compliance, advisory, and now tax filings with 1065, 990Ts, 1099-Rs for solo Ks, and the like. So super psyched about that, and more to come. If you check out this video next week, I will explore the ins and outs of our new tax filing services. So thank you to everyone who spent some time with me today. It went a bit long, but hey, it's fun. And that's the beauty of the IRA. You don't have to get crazy into tax. There's no tax. So anyone that doesn't like paying tax, doesn't like dealing with tax returns, you should be doing more in your IRA. Because other than UBIT, you're never going to have to deal with tax. You don't have to worry about deductions or basis or holding periods, short-term capital gains, long-term capital gains. What's my tax rate? You don't have to worry about it. Okay. So yeah, James, we do 990Ts too now. Yeah. So we'll be in touch. That's due April 15th. So in the coming weeks, you'll be receiving information. If you are an IRA or 401k investor and subject to UBIT, meaning you've generated more than $1,000 of net income from a active business through an LLC owned by a retirement account, use a non-recourse loan to buy real estate for an IRA. Remember, there's an exception for 401ks. Or if you use leverage to buy an asset in an IRA or 401k, generate more than $1,000 in net income, we will help you and complete the 990T. So it's an awesome service. We're really the only company in the country that not only is the best at establishment and administration and advisory, but now do tax filing. So I'm super psyched about this and hope our clients take advantage of it. So otherwise, have an amazing day. Thanks for spending some time with me today. Really, really, really appreciate it. And I'll see everyone again next week. Take care. Don't forget to leave a comment. If you have questions, you can email us at info@IRA Financial. You can call us. We actually answer the phone. Yeah, we have an amazing team of client relations, tax professionals, available 9 Eastern to 6 Eastern, 5 days a week. Call us. You don't have to be a client. Just call us, ask us questions. If you're interested in IRAs, full OKs, maybe you want to know if their investment's prohibited, what's UBIT, what's going on with this, that, we'll get you an answer. Don't worry. You don't even need to be a client. We just want to help. So hopefully you'll end up being a client, right? If you're smart enough. Right? I spoke to someone yesterday, and it's the last thing I'll say. And he's like, Adam, I'm using another IRA custodian. He spoke to me, he got my email. I think he hit me up on LinkedIn, actually. Got my email, and I said, hey, just call me. He's like, I'm using this company. I'm paying $1,200 a year, and I have this question. They're not answering it. So I gave him the answer. He's like, okay. I'm like, you're going to move your IRA, right? He's like, yeah, I guess I could. I'm like, well, why wouldn't you? You're going to save, $800 a year, and you're going to get answers quickly. He's like, you're right. I should. Why wouldn't I? So again, I'm not objective. I know I've started this. I founded this company, but we are the best out there. And that's why we're the fastest growing. We care about what we do. We care about our clients, and we have the smartest and best clients. So if you care about self-directed retirement investments, if you want to be a better investor, if you want to join the 25,000 IRA Financial Self-Directed Retirement Nation, be a client. It's so much fun. Our fees are super reasonable. We have flat fees. We don't even have wire fees, right? Where are you going to find a company no wire fees? And you're going to have a good time, and we're all going to learn from each other. So that's it. Obviously, if you already have an IRA and you're happy, great. There's amazing companies in our space. I love our industry. That's cool too. And if you just want to call us and ask some questions, that's also cool. Like, we'll help you. But if you're looking for a self-directed IRA home, if you don't have a home yet, we'd love to be your home and grow together. So thanks for hanging out today. Have a great day, and take care.